Good morning. My name is Vince Lancy, and this is the Goldfix Market Rundown. It's 8:06 in the morning, and there's our homepage. We will be discussing the lower left-hand story, 5 crucial observations on gold miners. That's based on an RBC report, which is titled 5 Key Observations on Gold Miners. And we'll tell you why we say they're crucial. Let's start with the markets themselves. 10-year yields are down almost 3 at 429.5. The dollar is 98.01, up 17. The S&P 500 is 64.41, down almost 5. The VIX is 1565, up 57. Gold is 33.46, up 11. Silver is 38.04, up 7. Very nice. Copper is 4.43, down almost 2 cents. WTI is 63.06, down 10 cents. Natural gas is 2.81, down a dime. Well, down almost 10 cents as well. That's 3% move. Bitcoin 115 and change, down 2,500. Very volatile between 114 and 119. Ethereum 42.95, backing off its highs significantly now. So taking a little bit of a breather. Palladium down 2 and change at 11.11. Platinum 13.30, down 6 3/4. Gold, silver stable under 80. Grains are uniformly soft, being marked down in sympathy with each other. Okay, let's get to it. This morning we sent this out. RBC's 5 crucial observations on gold miners. RBC Capital Markets reported on gold equities last week, and they noted that these equities have strongly outperformed bullion, reflecting improved fundamentals and investor interest. The bank points to 5 drivers. Equities are up 25% versus gold's 4%. Robust Q2 earnings with higher production and lower costs. Conservative but resilient reserve assumptions for 2026 planning. Barrick's 4-mile project with world-class potential. And Uzbekistan's, I'm not sure how to say it, Navoy Mining, preparing a $20 billion IPO. Valuations remain attractive and capital returns continue to expand. Continuing, we broke it down into, these are the 5 things. We just want to say something quickly about each one. Gold equities outpacing gold. They noticed that and they are saying that's unusual. Second, and we go into that a little bit as well. Lessons from second quarter earnings. RBC covers miners extensively, and they go through their earnings calls and what the takeaway was in sum as well as individually. Planning for 2026, reserve and budget assumptions. There's a 2-word phrase in there that we noted is extremely important. That says to us that the miners are being told again to hedge, and they will be rewarded for hedging. 4, very specific to Barrick and very pointed comments. Interesting. Barrick's 4-mile project. They have some insights into that. And then the 5th one is the potential IPO of Navoy's mine. And then RBC's bottom line. It's a discontinuity there. Now, this is a dry. We broke it down because most people know miners that are miner people. They're not tourists. So we just broke it down. We're going to have some of our particular types of insights in a follow-up mini pod outside of the fundamentals, which everyone understands. But I want to share why we called it crucial. Here's one of the footnotes. We noted in the beginning, puzzled's not the right word, but let's just say they note it's unusual that miners were outperforming gold. And so our response is, and this is, by the way, this is an alarm bell for us, a good alarm bell, to say the following. Just as banks were puzzled why gold was going up with a strong dollar and high rates in 2023, now they are somewhat puzzled as to why equities are rallying when gold is range-bound. Perhaps they should be asking why equities never rallied when gold did for the last 2 years. We believe this truth that they haven't connected or disconnected the markets from each other, makes their analysis crucial for what it observes and what it does not observe, just as people did not observe that neo-Keynesian correlations were not affecting gold anymore. Well, traditional fundamental correlations are not affecting miners anymore. Or let's put it this way, traditional fundamental correlations are just coming back to affect miners now. Years of apathy, this is the years of apathy created a lag in broader acceptance, but that acceptance has begun. The lag is still there. It will not move in a straight line, as this report exemplifies, but it is moving now. It's reports like this and observations like we're hearing. It's a very, very good piece um, that make us enthused because they're not talking about platitudes. Mining is this, mining is that. They're talking about specifics, about companies. There's variety in what's going on, and they're talking about IPOs, and they're talking about implicitly what they're advising miners to do and what miners are doing, and it's happening. And that shows me movement in the direction that we've been waiting for. That's your signpost, as people like to say. That's your tell. That's, you know, the miners looking back to look at you when you walk by them. The miners are starting to look back a little bit, or people are starting to look at the miners when they walk by. And that's what I wanted to make that point on. Related post, Hartnett doubles down. Oh, I'm sorry, I forgot to plug the actual post. Full analysis is in the premium post, RBC's 5 crucial observations on gold miners. Related post over the weekend, Hartnett doubles down on gold revaluation and raises allocations. There was a lot to talk about in there. And, we're very fortunate that the guy's talking about gold as much as he is. But he doubles down on gold revaluation, almost in passing, but we make a point of it. He talks about yield curve control, which was not our focus, but it is very key to one of the things he's saying. Yield curve control and gold revaluation are related as far as we're concerned. And we believe we've spotted him pointedly telling his equity managers, hey, you don't have enough gold exposure. And we believe that gold exposure is going to ramp up at the money managers globally. Gold versus stocks, debunking the myth. That's our piece on gold versus stocks, or gold versus bonds as a hedge for stocks. It's a 60-40 portfolio, but there's a lot of insight in there from a recent piece by Michael Oliver. He had some of the data that we used, and so we cite him accordingly. The LBMA Ministry of Bullion Truth, that's a follow-up op-ed piece on what we think the LBMA is really about and why their demise is long overdue. And Sunday, we put out a piece called How and When to Take Profits. That was a precursor to the Sunday founders discussion, which was over 3 hours long, was well attended and over 3 hours long. And people asked a lot of good questions. And we covered primarily how to trail stops on winners. And some of it was wiring brains, and some of it was managing your own personal expectations. And we talked about several other things as well, including the geopolitics of the situation, as well as the psychology of trading. And then there's the live Trump-Putin meeting in Alaska on the tarmac. And that was our weekend. Moving on. Data on deck. This week is a housing week. And so if it's housing, if it's mostly housing, then it's economics. So you're looking for data to be weak. If there's weak data, then that would push the Fed more towards worried about recession and stagflation. So they'd be more inclined to ease. And it doesn't matter what happens. I think the market just thinks they're going to ease no matter what happens now. I think they'll be potentially in for a rude awakening, but I don't know. The other key part of this week is the Fed minutes for the July meeting are released, and people will be looking for where the dissent comes from and how often concerns like dual mandate tension. We're worried about inflation. No, we're worried about unemployment. Like we want to see how they diverge if you're tape watching as it is. And Friday is a day off. Jackson Hole is coming up as well. And there's that mining story again. Let's take a quick look at the charts. There they are. Excuse my sniffles, please. Gold's in the middle of the range. Be happy. Be happy because right now producers are hedging the crap out of their inventory and the market's holding. Really good sign. So if you're a technician, you're like, oh, it could be a distribution top. Maybe. It could be a 4-month pause before the next move higher. I think the end of the Ukraine war, while it should be obviously bearish because there's a return to some semblance of peace, might not be bearish a month later. I think there could be monetary reset implications from it. And I think, you know, a large part of this community is anti-war. I mean, who isn't anti-war? But I mean, means it. And as such, uh, we're for Trump brokering a peace, as am I. The problem is, if you're European, you see history repeating itself here. You see Putin being enabled, Putin being permitted. And by the way, that's what I would do if I was Putin. You take as much land as you can, you give a little bit back, and you're happy with it. The question is, will he be happy with it? I think there's, I think, I think in the eyes of Europe, appeasing Putin and giving him what he's already taken it. He's got it. Trump's being practical in that sense, and so is Putin. But it may create certainty in the US because it's over, but in Europe, it creates uncertainty because they're worried about the next shoe to drop. And so, how the war ends in the Ukraine, if it ends, is more important than it's ending. Let's go back to peace. We're not going back to peace. This is the beginning, and money will probably never be the same after that. All right. So I'm Vince. Long gold, long silver, long Bitcoin, long Ethereum right now. And holding on to my silver beyond the fact that I have no signals, except that I like the bigger picture, kind of like a physical holding. And gold, very mildly long gold because I'm a moron. I shouldn't be. We're in a range, but that's the way it is. I'm Vince. Have a great day.